Good evening and welcome to our 10th halftime report. It's a pleasure to see everybody here. I haven't seen this many people in a room in a long time, and so maybe we're slowly getting back to normal. What do you think about the stock market this year? Yeah. It's definitely been a challenging year. There's so much going on, so much information coming at you. It's hard to believe that the world's not coming to an end. Everything seems upside down. Information's flying at you at 90 miles an hour, and it's hard to concentrate on what's really important. As your advisors, we see one of our roles is to be a filter to weed out some of that noise and boil it down to what it's important for you to know about the stock market and the economy. This is one of the reasons why we send out our weekly wealth report, as well as an occasional investment letter, and why we do these events. We do these events so you get an idea as to what we're thinking about and what to expect from the market in the next 6 months. But we also do these events as a way to just have a community and for you to maybe hook up with some old friends. Like I know there's a little mini reunion from Fireman's Fund going on. And maybe you'll meet some new friends and we'll have some fun along the way and eat a good meal. And we'll continue to do these events as long as you find value in them and continue to come. How many people in this room went to the Big Shred this year? Yeah, pretty good. That thing is taking on a life of itself. This one was our 10th year, and we joke in the office because we thought the first year nobody would come, and so we visualized we were going to have Kareen. Remember Kareen? We're going to have Kareen sitting out on a stool with just a little shredder with a plug-in shredding machine. But you guys came, and we had it at our office for, I don't know, about 4 years, I think, and then it started to get bigger and bigger and bigger, and the neighbors started to complain. So then we moved it across the street by the Shamrock place, and the third year we did that, it was pretty much chaos, and we had cars that were backed up on Redwood Boulevard all the way down to Trader Joe's. And luckily, Father Tony from Our Lady of Loretto let us use the school ground, and so it's been great there. So we now, we had actually 4 shredding trucks this year at the peak of it, and we shredded 18,000 pounds of paper and raised just a few dollars short of $10,000 for Homeward Bound and for their veterans homeless. So we have a little video I just wanted to share with you for those that missed it. This is what it looked like on June 25th.
Hello, I'm Tom Davis. This is Tim Russell. Tim's the founder of Valley Oak Wealth Management. This is the 13th Big Shred, and what we've done each year is try to raise money for the community. This year it's Homeward Bound Marin. Yep. And we're using 100% of the proceeds of the donations that we receive go directly to Homeward Bound. The entire staff of Valley Oak Wealth Management is here, and we have a bunch of volunteers from the folks over at Homeward Bound. Last year we raised, I think it was like $14,000. This year I think we're on track to maybe meet or beat that, so we'll see. Thank you very much, everyone here in Novato. I saw some folks from Sanderfell, Southern Marin, all the way up to up by Katati. People had said they come from seeing the sign, so really thank everyone in the whole Marin community for coming out and making these donations and shredding your paper.
Valley Oak Wealth Management sponsors this event every year to help raise money for us, and we're so grateful. People appreciate the service, and it's a big benefit for our programs.
What you don't know about that event this year is that we got a call about a week before from the shredding company and said that their drivers all have COVID and they wouldn't be able to attend, and asked if we could change the date. And so we were in somewhat of a panic, but it all worked out. Some of you might have noticed that we've had some changes to the team in the office, and I'm sad to report that Jim and Maria have both moved on, but the good news is that we have Robin Dahlman, who has recently joined the team. I think she's in her 5th or 6th week. You met her when you came in. There she is back there. And Robin has several years of experience as an executive administrator in various industries and office environments. She's worked all over the Bay Area and abroad. And what I've noticed most about Robin is the fact that she's totally committed to customer service. She understands what it is to deliver top-rate customer service, and that you can't teach. She has a willingness to do that. She's very meticulous. Is somebody that you really want working on your team. We're happy to have her, and you'll be glad working with her for years to come. I also would like to introduce to you our intern, Carlo D'Afonso. There he is, the man. Carlo's a junior at USC and is studying business administration and political science. He's part of the GEM cohorts of the Leventhal School of Accounting. He's actually extremely bright, and he's been instrumental. He's been very helpful around the office. He does anything that we ask him to do, and never complains, shows up on time. I think he's actually one of our best interns that we've had, with the exception of you, of course, Will. And speaking of Will, Will's back there with Carlo. Will does the research and the trading. He's kind of the Swiss Army knife of the office. And let's see, so Tom Davis is around here. There's Tom. You'll hear from Tom a little bit. And Ann back there. Ann's instrumental in putting this whole meeting together. I don't think anybody helped her, and she did it all by herself. So thank you, Ann. Okay, Robin helped her, I think. And of course, you know Lucy, our photographer. So Lucy's been to many of these events. And standing next to her is our newest employee, and that's Jackie Davis. So Jackie you're going to be in 4th grade this year? Yeah, 4th grade. So have you ever had the experience of running into somebody that you've known for a long time, maybe somebody you went to high school with, or somebody your age, and you're looking at that person and you go, man, do I look that old? Have you had that experience? Well, recently I went to a new dentist office, and I was sitting in the waiting area, and I was looking at the diploma of the dentist, and it dawned on me, I go, I think I actually went to school with this guy. And he was extremely popular, tall, good looking, all the girls liked him, played all the sports, got straight A's, one of those guys. But when I saw him, I saw this old, bent-over guy. He had just gray hair around the edges, thick glasses that hung on the end of his nose. His face was all wrinkly, hairy ears, and I'm like, there's no way this is the same guy. And so after the procedure, I had to ask him. I said, did you happen to go to Terra Linda High School? And he said, why, yes, I'm a Trojan. I graduated in 1977. And I said, you were in my class. And he leaned over, and he looked at me, and he kind of looked over his glasses, and that wrinkly face, hairy-eared son of a gun said, what did you teach? So one thing you need to embrace is there's going to be an avalanche of recession warnings. That's the conclusion from yesterday's CPI report, as inflation hit yet another 40-year high, which almost guarantees that the Feds are going to hike interest rates at least 75 basis points this month. And this is going to put even more pressure on the economy and the stock market. News of continued surge of inflation are blaring across mainstream and financial media, and there's hardly any investor out there that doesn't know we still have an inflation problem. Meanwhile, the Bank of Canada just raised hikes 100 basis points, And the expectation here is that the Feds will do the same. There's a 50-50 chance of, in my opinion, of that happening. Looking past the volatility, here's the bottom line. Inflation has not yet peaked. Interest rates are still going up. Recession warnings and predictions will keep coming across all financial media outlets, and this will lead to more volatility in the weeks and months ahead. Given this prevalence of a recession warnings, I wanted to explain exactly what a recession is, and more importantly, what it historically means from a stock market performance. So what's a recession? A recession is determined by the National Bureau of Economic Research, the NBER, which is a private nonprofit organization that conducts economic research and most notably decides when a recession starts and when it ends. Broadly speaking, a recession is defined as 2 consecutive quarters of negative GDP growth. The NBER is not a predictive organization, at least not when it comes to recessions. In fact, recessions are often identified by the NBER long after the real slowdown occurs, and the economy has already ended. The economy has already ended, and the recession has already ended, and the economy is already into recovery. It's very much more of a backward-looking endeavor that's meant more for economic history and posterity than it is for us to help navigate. Well, how do we know when we're in a recession? Well, the first thing, manufacturing and service PMI will decline. Unemployment will rise. People we know will lose their jobs or have bad years. You'll see it around town where construction will slow. And then recreation items will begin to decline and become a buyer's market again. Remember those? I've been asked, are recessions bad for stocks? Well, it ain't good. But most recessions aren't as bad as one would think. We went back and we examined the returns of the S&P 500 for the 8 official recessions since 1969. And the average return was minus 7.58. 3 of those recessions actually saw positive returns. 2 others saw moderate declines. And finally, the 2 worst periods were in the US economy for the last 50 years were the 1970 stagflation, where the market was down 22%. And we mostly remember the financial crisis where we saw the market down 37%. It's important that recessions are it's important to remember that recessions are the ultimate result of policy mistakes. Either the Feds tighten too much or too quickly, or the government makes some sort of policy changes that cause some economic catastrophe. But often the market pain has already been felt, mostly runs its course before the recession occurs. That's because markets are looking forward. They're not looking in the rearview mirror, they're looking forward, and they're already pricing in what they expect from the economy. So by the time the recession actually occurs, the market is already looking forward to the recovery. To demonstrate this, I expanded our research to look at the performance of the S&P 500 6 months prior to when we went into a recession and 6 months after. The average return of I'm just looking at my notes here. 6 months of recession. So out of those 8 official recessions, 5 of those recessions had positive returns of 14.3%. So what's the takeaway? First, the recession is a major buzzword right now, but don't let that significantly scare you. Recessions themselves are arbitrary. They're arbitrary designations, and the economy slows well in advance of any official recession. Most importantly, market declines occur long before recessions are declared. That's why at least partially stocks are down this year. So for the most part, a recession has already been priced in, a partial recession has already been priced into the stock market. Second, history implies that it's the duration of the recession that's most important, not whether or not the economy goes into a recession. This time, to me, it seems a little bit different. It seems a little bit more normal, where the Feds are going to aggressively hike rates to cool inflation and growth. And when that goal is achieved, they'll cut rates, and the recession will be intense but brief, and the recovery's long and lasting. In my opinion, the Feds need to be aggressive. They need to break inflation as soon as possible, almost regardless of the short-term economic fallout, and then get to the point where they have tamed inflation and can cut rates to support growth. An economic slowdown is inevitable, and stocks are pricing that in. History implies the key going forward will be to break inflation quickly and decisively so relief can be given as soon as possible. As a result of that, I expect to get even more questions from clients, friends, and acquaintances about whether they should cash out and cut their losses. We know from market history that abandoning your long-term financial plan, even amidst intense market volatility, has always been the wrong move over the long term. So one of the biggest challenges that we're going to face at Valley Oak Wealth Management is to make sure you don't abandon your long-term plan and pull money out of the stock market. We feel our defensive positioning and our large cash reserves will allow us to ride out the volatility, but we're not going to be immune to any more market losses. What we recommend is that you consider postponing any major purchases. Just wait. Now's not the time to get a new car. Now's not a time to get your kitchen remodeled. You want to get a new car when it's in a buyer's market and it's coming. And you want to get your kitchen remodeled when the contractors are drying themselves with the shower curtain and not lighting their cigars with $100 bills. The good news is that this could ultimately lead to one of the best buying opportunities in decades, but for now, patience is paramount. Thank you. I'd like to have Tom to come up and talk a little bit about our strategies and what we like and don't like. And Tom is, we've been working together for 6 years. Yep. And Tom's been affiliated with LPL for about 20? 18. So you all know Tom. Tom's the nice one in the office. I'm the mean one. So just I'm the tall one, the mean one, the nice one, the short one. Anyway, Tom, it's all yours.
Thank you, Tim. How's everyone doing this evening? Good. All right. Good. I just want to talk about a couple things about what's going on in the market and really discuss the areas of the market that we favor that have been a little less volatile than the market has been in the last 6 to 12 months. Regarding equities, we really tend to favor domestic equities, primarily large cap, and they lean more towards value. Large value or dividend paying stocks, specifically large value stocks, show a stronger ability to keep their head above water in risky times, better than their growth counterparts. These are companies like Morgan Stanley, Walmart, GM, FedEx, compared to companies like Netflix, PayPal, Tesla, and Uber. Those tend to be more on the growth side. So you might be wondering, what's a growth stock? What's a value stock? Well, growth stocks are classified as companies that have the potential to generate substantial positive earnings and revenue, and those are expected to increase at a faster rate than the average company in the same category. Value companies are companies that are trading at a lower price to what the company's performance otherwise indicates. So in simple terms, they're undervalued companies that have more free cash flow on hand to use when needed. So you might be wondering, why wouldn't I just invest in growth companies that have the potential to outperform? Well, that's a good question, but they're more risky, obviously a little bit more volatile, and they are a little more sensitive to rising interest rates, and especially with regards to falling consumer demand. So in times of economic uncertainty, it's the value companies that pay higher dividends that tend to provide the opportunity to ride out the current market cycle. Holding cash, that's another option that we've deployed to fight the volatility. With that, most areas of the market are in the red, and cash can still be a great vessel to manage volatility, but it is subject to inflationary risk. Let's see, another area we like are short-term bonds. We like them obviously for the shorter duration, which makes them less susceptible to rising interest rates. and the rates have been hiked, 1.5% so far this year. So it's truly been the worst year for bonds on record. So we've seen core bonds dip between 11 and 13% this year alone. So essentially wiping out the buffer that they've always provided historically. There's always going to be areas in the market that are going to outperform depending on the current market conditions. So it's vital to be flexible in the changing environments. So for now, I'm going to turn it over to Andrew with Franklin Templeton. But before I do, I'd like to mention that we are an independent advisory firm. So we actually are the ones that get to select who we partner with. So we carefully select the best of breed in terms of money managers. And Andrew happens to be one of the companies with Franklin Templeton that we have in our little circle of trust. So, Andrew?
I better not break that circle of trust, right? As Tom said, my name's Andrew Prupis. I'm a vice president and senior advisor consultant with Franklin Templeton. I've had the privilege of representing Franklin for the last 16 years. And when I was preparing for this introduction for Kent, I was looking at my bio and I said, wow, I've been with the firm for 16 years. That's a long time. And then I brought up Kent's bio. He started in 1991 with Franklin Templeton. That's what, 31 years? 31 and up. Yeah, not to make you feel old, I'm trying to build up the expertise. But all joking aside, we're very excited to have Kent join us this evening. Kent is the senior vice president, senior institutional portfolio manager of our multi-asset team here at Franklin Templeton, which now manages close to $120 billion. Kent serves on the global equities team of the Investment Strategy Research Committee and a senior member of the Franklin Templeton's Fixed Income Policy Committee, which helps formulate the firm's in-house view on the bond markets around the world. Prior to his current position, Kent was the lead portfolio manager of several of our mutual funds here at Franklin Templeton. And before that, he actually had the distinct opportunity to work directly with Sir John Templeton, which is still today considered one of the greatest investors of all time. Kent holds a bachelor's degree in economics from Northwestern University and an MBA from UCLA Anderson School of Business, and holds his Chartered Financial Analyst designation. Please help me welcome Kent Shepard.
Well, it's really an honor to be here, and I couldn't help but notice, gentlemen, in the second table here, is that a U.S. Navy cap? Thank you for your service. It reminded me, when I was listening to Tim and Tom, it just reminded me, and I'm sorry, we have Go Army, Beat Navy, because my niece and nephew both went to West Point, so that one day a year or on other sides of the field. But I was asking my niece, who was training to run a armored vehicle division in the deep back parts of Texas where there's no people, and the testing and training got more and more intense with live ammunition, and weeks after weeks after weeks. And eventually she asked her commanding officer, why so much repetition? Why are we doing this so long? And of course, you know what he said. When this really happens, you need to not panic. You need to have been there. You need to have experienced, mentally processed what combat and volatility is like. Being prepared, both financially but also psychologically, is essential. And I just really admire that the advisors you have, managing expectations, talking about there's some tough news to come. It's not to overreact to, but it's not to be surprised by either. I have found over 35 years in this business, the largest single loss event for individual investors is finally losing conviction after a pullback, and then they're not there for the rebound. So please listen to these fine gentlemen and allow them to prepare you for what could be a little more of a rough patch going forward. So I think that's just a great place to start. So what I'm going to try to do is kind of put this unique period we've been through in some context. And I really, truly do believe we're at a major inflection point, a point of change in economic, financial market, and monetary policy history. There are changes happening now that are noteworthy literally in the lifetimes of anybody in this room when it comes to things like interest rates and inflation and the economy and how that ripples through our investment portfolios. So I'm going to try to frame that a little bit. You already heard enough about me, so we'll skip that. How we got here. What were the economic events and policy responses that got us to this point in time? Well, I don't think anybody needs to be reminded by me that the pandemic was one of the most brief but severe blows to our economy in history. Now this line here is gross domestic product. That's a fancy word for saying total economic output, GDP. That's the go-to measurement of economic activity. Negative 31%. Sorry for those in the back, but this line starts in 2011. I have to go back to the 1940s to find a line that fell that much. So it's important to remember when the entire economy shut down briefly but severely, it catalyzed an absolutely enormous, and in some ways appropriate response by our monetary authorities. Now, the back half of this, I'm going to talk a little bit about the side effects and the problems of that response, but I think it's fair and honest and honorable to talk about how it helped. You know, many households had food on their table because of the government's sending money directly to households. Many corporations stayed open only because government policy allowed them to borrow money. The company I like to think of as an example is Carnival Cruise Lines. Has anybody ever cruised before? How many people cruised during the depths of the pandemic? 1, 2, wow, 2. Well, maybe you're the 2 passengers that Carnival had, because their revenue went to almost zero. But even when their revenue was being annihilated due to forces not their fault, they were able to borrow money by issuing bonds that yielded only 6%. So because of that, that company is alive today. They employ people, they provide a service that people love and enjoy. So I tip my hat to the policies that did some good. It's also fair to say that total earnings of US companies, the S&P 500 we know is the index of 500 biggest companies. If you aggregate them all and add up their earnings as one, you can see that we are now back to earnings well above the pandemic, before the pandemic. So what I'm trying to convey to you here is a great deal of healing has occurred. Corporations and individual households. I won't bore you with things like profit margins, but companies are profitable again. The money they have to pay off their debt burdens is very healthy now. Cash interest coverage ratio is a term bond managers use to analyze how much cash you have compared to your obligations. So companies are in a good shape in that regard. And US households even. How much of your disposable income are you spending on debt obligations? And it's fairly low. That line being low means US households are in pretty good shape. So some of the extraordinary measures the government took helped. I want to start with that, and before I get to the less positive critique. So I've concluded that we just have been experiencing an epic tug of war. This tug of war was between forces that drive down prices in an economy, disinflationary, and forces that drive up prices in an economy, inflationary. And frankly, until just recently, for more than a decade, disinflation was winning. Technology makes us more productive. We all look online before we buy things. Technology makes it's much more efficient at making things globally. Globalization means if the world is a factory, free trade makes that factory massively more efficient. Make it where it's cheaper and then transport it. And it's really, really transformed the world. And globalization, trade, but also demographics. As people who are 70 consume differently than people who are 30. They're not building a household and a family, so there's been some less demand for certain things. These disinflationary forces were so prevalent and persistent that it gave us a false sense of confidence. And with the good intentions that worked, our US government engaged in more and more and more traditionally inflationary things, there was a pile of kindling and we kept pouring gasoline on it, but it wasn't inflationary. This persistent lack of inflation led to a complacency that arguably led to an overshoot. Now you have extremely accommodative monetary policy making rates low and creating a ton of money supply. That too didn't quite light the fire of inflation. The pile of kindling was soaked in gasoline. All it needed was a spark. How about a supply shock of global proportions like the pandemic caused? How about a major geopolitical event disrupting 1/3 of the world's wheat and other grains? And how about a noble intention of eliminating fossil fuels when we don't quite have the infrastructure to replace it yet? So, and now we're rethinking, you know how long I've been waiting for that couch from some part of the rest of the world? I think I'd rather pay more and have it made in Indiana or North Carolina. So corporations are waiting for semiconductors. Even Ford Motor Company can't make enough because they don't have enough semiconductors. So a lot of corporations are rethinking globalization, even if it costs more to make it here. So suddenly, the tug of war has shifted, and now lo and behold, sorry for those in the back, as was mentioned by Tim and Tom, we have some of the highest inflation in decades. I went to college in 1982. I went to Northwestern near Chicago undergrad, and in my freshman year, Paul Volcker had to raise interest rates to 16 and 17% because inflation was so bad. Well, that's not the worst thing. We lost 34 football games in a row too. Remember? It's a true story. Northwestern, 34 straight games, and on a soggy November Saturday, a fellow freshman comes off the bench, and we beat Miami of Ohio, the powerhouse of the Midwest. Our quarterback, his father is also the father of discount brokerage. Sandy Schwab out of Piedmont, California, was our quarterback that day. So anyway, that's the most important thing that happened in 1982, but we finally won. But what really has caused this inflation? And I've touched on some of it, but this is the quantity of money that the government controls the supply of. This is the growth in economic activity, GDP. Usually they track each other. But in this last 2.25 years, 42% of all of the money ever created by the United States government since our founding was created in the last 2.25 years. Pretty remarkable. And I want to emphasize, it was intended to help, and it did. But now from an investment perspective, we have to understand the implications that your excellent advisors are guiding you through. An enormous quantity of money. Think of it this way, there are many more units of dollars now chasing a relatively unchanged quantity of goods and services. And that's historically been inflationary. And now with those other assists from these other disruptions, it truly has become inflationary. You hear these terms like quantitative easing, QE. Our industry loves to take the relatively straightforward and make it more complicated by putting a weird name on it. We even have a new word for temporary. Transitory. For goodness sake, let's just call it temporary. Anyway, quantitative easing is really the government buying bonds in enormous quantities so that the prices of bonds stay high, because when prices of bonds stay high, interest rates stay low. When bond prices fall, interest rates go up. And that means borrowing money after that move is more expensive for your mortgage, car payment, Carnival Cruise Lines. Their bond issuances have to be higher coupon yield if rates go up. So this is the balance sheet or the investment portfolio of the US Federal Reserve. It grew from under $1 trillion to almost $9 trillion. That was the result of every hour of every trading day for weeks and months and months. Every hour the US government was buying $520 million of treasuries and mortgages every day, all day, 5 days a week, 8 hours a day. They did that to keep bond prices up and interest rates down. To a certain extent it worked, But where does the government get the money to do all that bond buying? They print it. So part of this was the byproduct of that. Now they've decided it's time to step back. It's time to step, you're getting an A+ so far. It's time for them to step back, so they've stopped buying bonds, and they're actually going to start to lower their portfolio called the Fed balance sheet. So that's one of the reasons interest rates are starting to go up. Think of it just a gargantuan buyer of any asset, an area of commercial real estate. They're buying up every building, every home. Well, when they stop buying every building and home, what's going to happen to property prices in that region? On the margin, they're going to soften. And that's why the U.S., one of the reasons, U.S. Treasury yields have gone from an all-time low of 0.5% to 1.4% at Thanksgiving to about 3% today. Now that's a very, very large move when you're at all-time lows. We just have bounced off of the lowest interest rates in history. And interest rates were so low because inflation stayed so low for so long. So, another 2 or 3 things that drove up inflation is the cost of the things that you make other things out of have skyrocketed. So this is an index of commodities: oil, food, lumber, chemicals, precious metals. You put them into a basket and average them. There was the transitory camp believed that we just have a temporary fall followed by a bounce. But don't worry, everybody, after the bounce, it'll flatline. Well, unfortunately, the flatline didn't occur, and commodity prices have gone up almost another 70%. You see it. You fill your gas tanks, right? You see at the grocery store. They've come down a little bit. They have come down a little bit, and therefore the conversation started, well, maybe inflation has peaked. That may well be. But for me, if I'm in the desert and it's 105 degrees, I'm not going to celebrate when it's 102 degrees. It's still really hot. So even if we go from 9.1% inflation down to 7 or 6, that still requires the Fed, unfortunately, to tap the brakes. Jay Powell is our Federal Reserve Chairman, and he said himself, I can't make oil, I can't make semiconductors, I can't make baby formula, but I can destroy the demand for it. And that's his job, to use interest rates to destroy the demand so prices soften. And that, unfortunately, is why recessions are often driven by government policy. And they have to do it because their job is to keep price stability. They also have to try to maintain full employment, but in cases like this, they've got to stop inflation. So I'm going to skip through a couple of things. The other thing that's been very inflationary is the job market. And this is what makes this such a unique pre-recession, because as Tim, I believe, mentioned, usually when the NBER announces that a recession happened, it's one of the key measurements is a spike in unemployment, a lot of job loss. We have some of the lowest unemployment in history right now. Household balance sheets are pretty good shape. Companies are pretty good shape. It's atypical, it's not normal. But right now, if you track wage inflation, we're 40-year highs. And one of the reasons is, strangely, almost 2 million Americans who left the workforce during the pandemic. I mean, I'm talking about prime working year age people, not people who would have retired anyway, for instance. Almost 2 million people haven't come back. And there's a whole bunch of reasons. They may have been furloughed and they're like, you know what, the heck with you, I enjoy retirement and you gave me a good payoff package to retire, I'm done. Or maybe they're afraid of COVID, or they're having long-term health care effects, or maybe it's still not worth it to them because by the time they fill their tank, get to work, and get home, the salary's still not enough. So we still have a very significant shortage of labor. So one way to look at it is, this is a little bit dated, so it might have changed a little bit. But as of the beginning of March, if every single American who's categorized as unemployed got a job tomorrow morning, you'd still have 5 million job openings. Now, I think that this number is dated and probably less, because we all know companies that have rethought their hiring plans in the last weeks, right? So this is probably an overstatement, but it speaks to this incredible mismatch. Anybody having a hard time getting a reservation at a restaurant, or getting a tennis racket restrung, or getting a kitchen remodeled? There's a lot of scarcity of services personnel, and that means that people working are getting higher wages. And if the US economy were one big company, 60 to 70% of that company's total costs are what? Wage related, compensation related. So it's the big needle mover. Now, an airline relies on gas prices. There's some exceptions, but in aggregate, wages are the biggest part of the cost of being an American economy. I'm going to skip some of this. Now, I want you to, if I can frame this as, when people say rates are going up, your question should be, what rates? Well, government rates. Okay, which government rates? I'm going to propose to simplify a structure. There's a long-term rate, and there's a short-term rate. I mean like overnight short-term. And the government tries its best to literally control the overnight borrowing and lending rates between banks. So if Bank of America has some excess tonight, and Wells Fargo needs a little overnight, what B of A will lend to Wells at the federal funds rate. It's banks lending to each other. And the Federal Reserve tries to influence that rate to make the cost of borrowing money cheap to support the economy, or expensive to slow down the economy. We have just been through a historic period. This goes all the way back to 1955. This has been the Fed funds rate all those years, talking 70 plus years. Here's when Sandy Schwab finally beat Minor Ohio, right about 1982. It's averaged 4.6%. Think of that net number, 4.6% the last 70 years, 2.5% the last 30 years. And yet, 9 of the last 13 years, we've been at 0 to 0.25. So it's, to exaggerate, the cost of borrowing money's been almost 0 for almost a decade. Might that seep into behavior in financial markets and how you value companies and how you value bonds? When the cost of borrowing is so low, you revalue investments that don't pay off for a long time as being more valuable. When rates go up, it lowers the value of investments that take a long time to produce a return because you have an alternative to your money. This is why this movement now, the reason I call this a major point of inflection in history is we, for almost a decade, had the lowest interest rates in history, and now that's over. And that is causing a massive, massive recalibration of every asset whose worth is tied to the cost of borrowing money. In other words, interest rates. And as the prior speakers mentioned, rising rates do change the value of virtually every financial asset. And the ones that are most vulnerable are the types of investments where your return happens later. A long-term bond, as referenced as a long-duration bond, is more rate sensitive. And a growth stock where a lot of the value comes out in farther years. They're the types of investments that get hurt the most. So when we look at a NASDAQ, it's not like the innovative, young, emerging growth technology companies suddenly became worse companies. It's just that the value of their future earnings is now more punitive because of rising rates. That's the essential story about why the market's gone down so far. So you might have heard the term yield curve. And I hope it's okay I spend a minute just to reintroduce that concept. Yield curve just means, at a given time, what's the yield on a 2-year bond in the US government? An 8-year bond, a 10-year bond, 50? It just shows you how the yield goes up as you buy a bond of longer maturity. That's all yield curve means. We have just seen all bonds of all maturities rapidly go up. From Thanksgiving or so to more recently, even the 2-year treasury has gone from 0.6 to over 3%. So the point is we've bounced off some of the lowest interest rates in history, and now that's behind us. So it has huge, huge implications for all financial assets. Now, I tried to take what was kind of a dull topic and spice it up a little bit. So we have another major tug of war here. Does anybody remember Tina Turner? Oh, yeah. What would be your favorite Tina Turner song? There you go. Okay. Is she simply the best? I don't know. Well, then you've got Marty McFly. Remember the letters M-A-R-T-Y? Remember Back to the Future? So what on earth is Ken talking about? Here's what I'm talking about. Bond yields were so low, and bond interest rate sensitivity, the risk you take in owning a bond was so high, that when you combine those, you were getting the least yield for the most risk in the history of the US bond market. So the return per unit of risk was extremely poor. That's why there was no alternative. TINA became a phrase in financial markets. TINA, there is no alternative. The folks on CNBC were saying, TINA. It's like, what has TINA got to do with this? This is what TINA had to do with it. Bonds were so dangerous that people were pouring into stocks, maybe even more so than they should have. Well, then all the interest rates started to go up. Bond prices fell dramatically. Corporate bonds, high yield bonds, high grade bonds, bonds of all types fell in price. If you bought a high yield bond, a basket of high yield bonds, the yields you get have jumped from 4.5% to 9%. They've doubled in 7 to 9 months. So suddenly, TINA's not the case anymore. Now Marty's in town. Marty means many attractive rates, terms, and yields. So suddenly, stocks aren't the only game in town, because I'm not saying bonds won't fall anymore, but now the yield you're getting on them has improved dramatically. You still need to be careful, as Tim and Tom mentioned. Still maybe buy the shorter term bonds, because they might fall more. No one really knows, but it's a reasonable possibility they may fall more. But the relative attractiveness of bonds has gone from the worst in history to a little better. So that's what I mean by Marty. So, the professor, what was his name? I forgot. Are we headed back to normal interest rates where at least you get enough yields to cover inflation? Maybe, we'll see. So, just a few minutes on, we talked a lot about bonds, but what about stocks? How do stocks like rising interest rates? And some great data already provided. If you lump history into two categories, periods when interest rates are falling, this is the rate of return on stocks. You get about 15, 16% a year. But the interesting thing is, where does most of that return come from? Less about the earnings growth, more about the multiple, the price-earnings ratio. So valuations rise when rates are falling. Unfortunately, as we've learned in the last 6 and 7 months, in rising rate periods, you can get some positive returns, but what used to be your friend is now your enemy. Multiples, price-earnings ratios collapse when interest rates are going up. Remember this point for a few minutes later. If earnings growth is good enough, you can still get some modest returns, but that's a big if. So what we've literally seen, and this takes a moment to digest, earnings have continued to grow, gray line. But suddenly, around Thanksgiving, November, stocks started to fall. Wait a minute, aren't earnings good for stocks and they're still growing? Yes, but like history taught us, the multiples, the valuation on stocks is what started to fall dramatically. And so the S&P 500 has seen the valuation. There's a term called the price-earnings ratio, and this is where you think the earnings will be the next 12 months. What you used to pay 27 times, now you pay 16. That's good. Like Tim mentioned, a lot of the pain, the market goes forward and prices it in. The market's forward-looking. So a lot of the negative implications of a recession and rising rates have already been reflected in share prices. And the NASDAQ even more, 42 times earnings down to 23 times earnings. When this line is falling, it means stock prices become more attractive relative to the earnings. So Warren Buffett, I think it was, used to always say, you know, if you like to buy hamburgers, don't you get happy when they get cheaper? I like to buy stocks. I'm happy when they get cheaper. So it's easy for Warren Buffett to say he's got a lot of hamburgers, right? But to a certain extent, he's right. Long-term investors should view falling prices as an opportunity to buy things at a better price. It's just having advisors you trust to keep a steady head and contemplate and rehearse how future volatility will or won't cause you to overreact. Skip that. You know, this is too much data. I'm not going to, but I'll tell you just briefly. These are a number of months after the Federal Reserve starts to raise those short-term interest rates. And as you go further and further out, these are 4 examples in history. A green number means the stock market managed a positive return. In the first 3 months, not so much. The early stages of a Fed rate increase, especially this time when we're starting at the lowest rates in history, tends to cause a massive recalibration of the worth of that financial asset. So it's what we've experienced, history tells us, is normal. As we get further out, the possibility exists that we can start to see more positive returns. I would just caution, history is a fabulous guide. It's the best place to start with a lack of any other better data. If there's patterns in history that can help us understand what's next, it's a good place to start, but it's not a guarantee. And I think it's reasonable to say that where we started this time, with some of the lowest rates ever, and some of the most rapid inflation in 40 years, a dose of caution should be applied, because this might take a little bit longer than usual. Let's skip that. So I said that if earnings stay strong, you can still have positive returns to offset falling valuations. But the market thinks right now that the S&P 500 this year will produce about 10% earnings, and almost 10%, 9% next year. And all these bars tell you, I'm sorry, in the back, consumer discretionary and industrials next year are supposed to be the strongest producers of earnings growth. Those are two of the most cyclical sectors in the entire economy. If we have anything approaching a recession, there's no way that consumer discretionary stocks are going to produce 22% earnings growth. So my point is there's still a bit of optimism that needs to be squeezed out of some of the expectations. We call that stale earnings forecasts. So it's not entirely clear that we're out of the woods yet, is the bottom line, because not only are rates going up, but earnings, one way to put it, wages are going up, but inflation is going up higher. So there's a bunch of Americans whose real wages have fallen a lot. And if you spend your entire paycheck on gas, food, and shelter, you don't buy other things. Target and Walmart have already warned that they're finding excess inventories because some of their customers have gone away. So we would just advise you to follow the advice of your wise advisors who are saying there could be some choppy times ahead. But we have, and they have, a game plan for you. They understand everything I've said here, and they're positioned, they've already positioned you to weather it in the proper manner. So I'm going to leave it at that. I'm not going to talk about any of our products or funds, or no commercials. I'm just going to say thank you for the invitation, and I'm happy to take any questions of any kind. Great question. The question was, what is the impact of the very, very strong American dollar relative to other currencies? And that's very, very true. I didn't comment on it. One of the things is it makes everything America buys less expensive when we buy from the rest of the world. It makes everything America makes more expensive for the rest of the world. So when you look at that negative gross GDP number we posted in the first quarter, and we probably will again in the coming weeks when the June 30 second quarter, the main reason the first quarter GDP was negative is, this is going to sound a little bit economic wonky, but there's a formula called GDP equals C plus I plus G plus NE. Any questions? Consumption plus investment plus government spending, but the first one is net exports, meaning how much we exported versus how much we imported. And we imported a heck of a lot more. So we had a huge trade deficit. So in that formula of consumption, investment, government spending, the net exports was a huge negative number. So it's kind of tricky this time because our voracious appetite to buy stuff from the rest of the world tipped our GDP number negative. So even economists who are PhDs, not just somebody like me, admit this was an unusual number because form of consumption strength, but buying from the rest of the world caused our GDP number to be low. So it's actually disinflationary, but at some point it becomes damaging to the US economy, where our exports become more expensive and less competitive. So it's like, there's no, I mean, there is such thing as too much of a good thing. So at some point, our policymakers are going to want the dollar to stop rising because it starts to hurt our ability to sell stuff to the rest of the world. Do I regard it as temporary? I think I regard it as a massive anxiety. I think investors all over the world sometimes view the US dollar as the best house in a neighborhood that's getting more shaky. So it's a flight to quality or defensiveness. But quite frankly, right now, if I'm an investor, say a huge government pension fund, and I can get 3% yields on a US Treasury and 1% in Europe or Japan, where would I rather invest? 1, 3. I can triple my yields. So I sell my yen in euros, and with those I buy US Treasuries for a much higher yield. So it's called interest rate differential. Where do you get the better yield? That's where the money flows. So I don't know if it's temporary or lasting. But currencies are one of the most difficult things to forecast, and the best currency forecasters in the world have like a really bad batting average. Because it's hard, and there's so many different factors. So I'm not even prepared to make a forecast whether it's temporary or lasting. Good question. Exxon's CEO mentioned that the next 5 years, oil will be tight. And the reason for that, and I take no political sides, so I definitely don't want to give any impression that I do, but Exxon's CEO and CFO are being asked to make investments of tens of billions of dollars that take 5 to 10 years to pay off. And yet they're being told the product you make will not be in demand in 10 years. So please spend the money, but don't have any guarantee that there'll be a demand or a market for your product. So capital spending, investment, exploration and production by the major oil companies, including Chevron, who just moved to Texas, by the way. What a coincidence. They're not spending money. And it's beyond my role to say whether that's, the intentions to reduce fossil fuel consumption is very noble. And the problem is that we're doing it at a pace where we don't yet have the alternatives lined up. So it's probably not at all surprising that oil prices have doubled because the demand is not going down very much, but the supply is plummeting. And it's because the companies that make it are being discouraged from making it. It's a fairly straightforward situation, and that's very inflationary. Every single physical object in this room was probably moved by oil, whether it was from Indonesia or Indiana. Fossil fuels still move most of the physical goods and people around the world. Now electric is getting there, and by the way, electric cars, where does 70% of the electricity come from? Fossil fuels. So it's a complex problem, and there's noble efforts. But economically, it creates some real headwinds in terms of inflation, unfortunately. The question was, what do you think about California muni bonds? Well, the first question is, when you buy a bond, you lend money. And is the entity borrowing the money in condition that suggests they'll be able to pay you back? That's called credit risk of not getting repaid. The good news is, every time you see a house in your neighborhood sell for a price you can't believe, the buyer is paying a higher property tax than the house before. So state coffers are doing very well, mainly because of real estate and property tax, but other reasons as well, employment and things like that. So the entity you're lending money to is in good shape. That's not the problem. The problem is bonds don't like rising interest rates. So we have to think about, has the yield on the muni bond gone up enough to compensate for the risk that inflation and interest rates are still going to go up? And I would say directionally, a good bit of that pain seems to have already passed. And there's some other dynamics in the muni market. And one other strategy you can employ that I heard your advisors mention is you can also manage or at least reduce interest rate risk by buying bonds or of all fixed income instruments, including munis, with shorter maturities. Now, there's no free lunch. A 2-year municipal bond yields less than a 5 or 7 because the 7-year bond entails more risk and the market compensates you for that. But if you're not convinced rates have done going up, one way to reduce that rate sensitivity is to own a short or intermediate term bond or bond fund, which I believe I heard your advisor articulate is part of their strategy as well. The question was, can you please comment on digital currencies and non-fungible tokens or NFTs? So I'm going to say I have a biased view. I'm a little cautious on digital currency, in part because I don't feel I fully understand it.
Does anyone?
Well, there's the curious thing is some very credible investors are behind it. Our CEO calls Bitcoin one of the most popular digital currencies, one of the great distractions to one of the great disruptions, meaning it's a sideshow. The digital currencies are a sideshow. The underlying technology called blockchain is going to be world-changing because it'll enable transactions to occur that are very transparent and less friction or complication. So it may well be that Bitcoin is the way we get our first look at the underlying technology called blockchain. There's an investor named Howard Marks who he's a kind of a senior spokesman in our industry, and I heard him speak at a conference, and I did a small presentation. He was the grand presenter, 800 people, and someone asked him the exact same question. Mr. Marks, what do you think of Bitcoin? He said, Bitcoin's a lot like gold without the L. It's fascinating and it's powerful, but its value is based on faith because it doesn't inherently make anything. So that never left my mind. It can be very powerful, but you better have faith in it. When that's gone, there's nothing left. So count me as a skeptic. And NFTs, I don't understand either, so I'll politely step aside on that one. The question was, there's an enormous, maybe even $23 billion, huge bump up in ExxonMobil's near-term earnings. And let's contextualize that. Is that too much? I think my response would be, if we asked a farmer in the Midwest who lost hundreds of thousands of dollars for 5 straight years, and then finally a bumper crop, and if you compare his bumper crop, where huge quantity of wheat and corn, and prices really high, what a year, what a greedy farmer. And I think we have to look at energy companies through the totality of the ups and the downs. And without occasional huge earnings years, they wouldn't survive the bad years. And there have been some really bad years in the last decade, going back 15 years. So I'm sympathetic, and I hope they don't price gouge. I hope they don't take advantage. But I think when one looks at those types of industries, we have to look at them across more than one obnoxiously profitable year, is my humble opinion. Well, thank you very much.
All right, thanks everyone. One announcement I did want to make is you see that lovely floral arrangement in the middle of your table. There is a sticker on one of the chairs at each table that signifies who the winner is. So if you've won that, please take it home and enjoy it. You'll see it's a white sticker.
On
It's right on the edge, right next to your left leg or right leg. Just don't fall over. You want to go help him, Jackie? All right, perfect. All right, everyone, temper your enthusiasm. We're going to wind this down. We have heard the word recession quite a few times tonight and in the news, but as you all know, it does have a negative stigma, but realize that it is a part of the economic cycle. So, in times like this, it really requires us to focus on the ability to navigate all the noise. And how do we do it? Well, we have access to folks like Kurt from Franklin Templeton, Shane from Columbia Asset Management, and Christian from Lord Abbott. So thank you guys, appreciate it. And one last thing, you know, we don't do any advertising. I see quite a few of you folks have been kind enough to provide us with referrals, so we really appreciate that. So if you happen to know anyone that has changed jobs, retired, or had some sort of life-changing event, or even lost focus on the long-term plan, don't keep us a secret. So thank you very much. I hope you enjoyed this evening, and we'll see you soon. Thank you.